Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Next up on our event schedule is the Planet MicroCap Showcase Virtual on December 6th through 8th, 2022. On day one of the event, we'll be hosting the first ever Stock Pitch World Cup. 6 global areas, 6 moderators, 24 total stock pitches. Joining us to moderate each special session is Maj Soueidan, representing the USA, Paul Andriola, representing Canada. By the way, happy Thanksgiving to all our friends up in Canada. Fadi Diab, representing Australia, Jason Hirschman, representing Europe, and Kelvin Sito, representing Asia. The only way to see the Stock Pitch World Cup is by registering now. And then on day 2 and 3 will be presentations from microcap management teams, as well as one-on-one meetings. Attendance for both events are complimentary for investors, and registration is now open for our virtual event. So to join us, please visit www.planetmicrocapshowcase.com. Now, for this episode of the Planet MicroCap Podcast, I spoke with Jeremy Deal, managing partner of JDP Capital Management. I last chatted with Jeremy on the podcast back in September 2020, back when stonks only go up. Safe to say the world is a little different since then, and things have shifted quite a bit. We got to chatting offline about the current environment, specifically how he's approaching investing in the eye of the storm. Jeremy was an active investor back in the 2008-2009 time period, so I wanted his take on how things are right now compared to then. Also, he sent me a paper by Meritech Capital about durable growth, and he's using this framework to help him through this difficult investing environment. We wrap up talking about how Jeremy would deploy this framework in microcaps. So thank you again for tuning in to episode 246 of the Planet MicroCap Podcast, and please enjoy my conversation with Jeremy Deal. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. All right, Jeremy, great to have you back. Thank you for being here. How you doing, man?
Hey, Robert, it's been a while. How's LA treating you?
LA, it's the weather's turning. I can't say that the leaves are changing or anything like that, but once it goes from 85 to 75, it's warm weather season or cold weather season now for us.
I mean, are there at least 2 seasons in Southern California, or is it really just one?
No,
that's the debate.
Here's really what happens. Once it gets to fall time, it becomes 4 seasons. The mornings is winter, and then mid morning it starts to become spring again. Midday is summer, and then as you get to around 6 or 7, it's fall, and then winter all over again. So we experience it all too. There you go. Well, look, Jeremy, it's been a couple years since you came on the pod. We published that interview back in September 16, 2020.
God, has it been that long?
It has been. Not only has it been that long, but like it's kind of a mind trip to think about, like how much the world has shifted really even since then.
So much has happened.
Just a lot. And now we're kind of ever since then, that was at a time when things were recovering very quickly. Stonks only go up.
Right.
The world wasn't falling. Everything was going through the roof, right? And now we're kind of in the eye of the storm. So I wanted to kind of start off because we were talking offline about this quite a bit, and I'm kind of sad that I didn't press record then, but we're doing it now. So how would you say investing in this eye of the storm is kind of different than it was back in 2008, 2009 time?
Well, I don't know. So I guess to start, the eye of the storm back in 2008 started with banks, and it started with, financials. And then it spilled over into other areas of the economy. And if you look at the companies, like if you were to kind of go, back in time and kind of back to plus or minus the bottom, whatever that, let's call it, sometime in 2008, early 2009, like, okay, you surveyed the landscape. You couldn't find a bank that was trading more than, let's say, at the most 30% of book value, but many, many, many banks were trading at, 5, 6, 7, 10% of book value, especially the small caps. And this was because nobody believed what book value was. These were toxic companies. And it was an asset class that was untouchable. So nobody even wanted to do the work to figure out, well, hey, maybe there's value in this book value. It's just like, we can't touch that. And so, insurance companies, home builders, for example, all down, 80+%. And then that kind of spilled over. You had, RV manufacturers, you had, of course, the industrials. Ultimately, everything was down quite a bit. But the real eye of the storm at that time were financials and maybe home builders. And yes, there were other things. There were commodity. There were other businesses that were miners and stuff that were also down a lot. But I had to think about how I was looking at things back then. As an eye, looking at the eye of the storm and looking for distressed or really overvalued or undervalued companies that had been oversold. Where I was really focused were financials, because that was the eye of the storm. And again, it's kind of like technology businesses today. They're almost considered toxic. So today, when you survey the landscape, as we all know, the sell-off started, it was led by technology, and a lot of it was kind of what people call non-profitable tech. So for whatever reason, the business is just not, making a traditional profit. That could be because they're just burning a bunch of money and they're dependent on the capital markets to stay alive, and they really have no long-term future. Or it could be that they're very, very healthy companies living within their own internally generated free cash flow, and they had just a very unique runway of opportunity to reinvest 100% of their gross profit back into the business. So it's a very wide group of companies that started out maybe, let's say, in the eye of the storm. And then over this last year, it spilled over into pretty much anything that touches the consumer. You could run a screen on the number of really cheap stocks or companies trading below 10 times earnings, or even less than 5 times EBIT. And there are many, many, many to choose from. I was just looking at the screen today. I was surprised to see companies like General Motors and Ford, down 45% year to date. And these are companies with big dividends. These are companies that, I don't know what their prospects are. I'm just saying, just purely looking at the landscape, what started with technology has now spilled out into the streets. So, without doing any real research, just kind of surveying the landscape, it looks like a lot of things, there's the potential for a lot of things to be grossly mispriced. But I don't know. That's kind of how I see it today. There's, I'd say tech is probably anything asset light is probably the most has probably been hit the most, and I'm sure within the rubble, there's probably a lot of great opportunities. In addition to companies that probably shouldn't be public because they went public via SPAC and they're just low quality businesses that should be private. And there's some real winners in there. So when I look at the eye of the storm today, that's what I see.
Very good. All right. Well, thank you for that quick overview, because that leads us into the main reason that we wanted to talk today, because you sent me an email with this paper that I found absolutely fascinating. This idea of durable growth, this was written by Meritech Capital, and when we were getting to talk about it online, it seemed like a great premise when we're in times like these. Because because there are going to be quality businesses that are going to have year-over-year growth. Maybe it's not the same projected, 50% CAGR or that kind of thing. But
right.
Still growing 20%.
Yeah. Right. Hey,
I'm dumbing this down quite a bit, by the way, because the paper was fantastic. I'll put a link to it when I share this, and also put it in the description. But for our audience, can you help us firstly describe this idea, and then we'll dig in a little bit.
So we were in the process of doing a similar research piece when I came upon this paper, and I just couldn't believe it. Now, I was really impressed with the paper. I was impressed with the framework. It's actually a simple paper. And we were actually doing the research not just focused on one industry. And Meritech's a venture fund, a big venture fund in the Bay Area. And so the purpose of this research for them was a little bit different. They're basically, I think the way it seems to me is they're kind of communicating to their portfolio companies, most of which are still private. And they're outlining what does it look like, or how can you preserve value and create value in a market that's declining. And so the point is to basically say, to their portfolio companies, like, you can still create a lot of value. You just have to learn and figure out how to preserve that value. And so the point of their paper was, look, we're going to look at the most successful public companies in software, as they're calling them SaaS, but they're lumping them all in together. So SaaS is software as a service, and it refers to a specific business model where you sell a subscription. But looking at the companies that they use, and the 100 plus companies in their research, it also includes just software companies other than just that particular business model. So they called them SaaS, but let's just say software. So I thought it was interesting. What they wanted to point out to their reader is that to achieve like the best returns long term, there's really only a few things that matter, and the most important thing is what they call durable growth. Now, we've done a lot of research on generally around this topic. We have, at the Survivor and Thriver Fund, we have kind of 4 components to what we look for in a business. And it's really around the ability of the business to continue to grow. It's around durability. We don't call it durable growth necessarily, but I thought that the way they put it together was really nice. So the premise is really simple. They say, look, we're looking at 100 plus companies, software companies since IPO. So some going back a really long time. Some are really mature, like Salesforce, for example. So several of these companies went public, 20 plus years ago, and they wanted to see in the research really what drove these amazing returns. So the top 25 returning companies earned, I don't know, something like, I guess I should look at the paper and see it. It was something like 13.5x or so return on average. And they wanted to see, where did this return come from? Did this return come from growth? Did this return come from multiple expansion? What did it come from? And so their premise was, well, we're just going to basically look at these companies and see what are the components to the return. How fast did revenue grow? What was the multiple? What did the multiples look like when the company went public versus how they are today? And compare those two, net of dilution, so stock-based comp, and just kind of see where it all pans out. And in the end, their conclusion was that the rate of growth has nothing to do with the total return of a business over a long period of time. What matters is the durability of the growth. And I think that this is something that the market tends to miss, because it's really easy to look at a business and just put a multiple on it or say it's overvalued or undervalued based on historical accounting. But at the end of the day, what really drives value, and what they go to great lengths to show through their analysis, is the durability of the growth. So not necessarily the growth rate, or actually definitely not the growth rate, but the durability of the growth in general. So if you think about like the opposite of this, if I told you I owned a business that was declining and had no growth, so it was declining, it would be, maybe you could say, well, if it's alive for the next 3 years or 4 years, how much cash could we suck out of that business and discount that back and put some kind of hurdle rate on it? And maybe if you could wind it down net of fees, hey, that would be great. So that makes sense. But when it comes to the opposite, when it comes to a business with a really long runway, and maybe it's not high growth, but it's durable growth for a really long time, that intrinsic value, yes, it's unknown, but it's a very, very long, potentially a really large intrinsic value. And so that is what the paper points out as kind of the driver, is that ability to adapt, that ability to, what matters is the ability to adapt, the ability to control expenses, and the ability to preserve durable growth, not necessarily high growth. So again, super, super interesting. And again, we're talking about asset light businesses where they really have a lot more control over their G&A and their P&L than the businesses that were at the eye of the storm during the great financial crisis, like banks. I mean, banks can only fire so many people. I mean, their problems were more about the liabilities. And so as the paper points out, successful businesses, that are going to come out of this more successful than when they entered it, albeit maybe at a lower valuation. They actually have the opportunity to make many, many multiples on their money from even the starting point, by finding that balance, by being able to cut costs, but also preserve the moat that they have, or their competitive advantages that will allow them to continue growing for a long period of time.
So Jeremy, would you say, is this concept new? I mean,
No, I mean, if you look at, this is kind of what Berkshire Hathaway does. This is what Buffett has always done. I mean, the paper again talks about tech, but you could apply this to any business. I mean, you just take any business that you can think of, a traditional business that's been very, very successful over a long period of time. And I'm not talking about just because it's been alive for, as a public company for 30 years, but who has really crushed the S&P 500 over a 20 or 30 year period. JB Hunt, for example, is a company we've done a lot of work on. So this is an old trucking company. I mean, the returns have been incredible since the mid 80s. I mean, the CAGR on the stock is, I don't remember off the top, maybe it's 10,000% or something. It's unbelievable. So there's a lot of any successful company at the end of the day, it does need to continue to grow. Just keeping up with inflation isn't really good enough. And so this has nothing to do with the size of the business. So whether you're a microcap or a mid cap or a mega cap, you need to be able to grow. And I think the paper points out that growth can decline substantially from initially it's 100% a year, 50% a year when the business is new and young, and it can go down to 15% or 20% and still create monster returns. And the reason the returns can be monstrous and outperform so big is because of the durability of that growth. It's just compounding. It's just compounding that revenue. And I think what the paper also points out is that if you give a business a long enough period of time, revenue is kind of encapsulates all the forces of financials over time, because a business can't stay public if it's just bleeding money, just dependent on the capital markets, just puking out shareholder value every quarter, every month. It's not going to stay public for 30 years. There's a level of sustainability that has to happen in a business, and ultimately that positive feedback loop is a result of profitability and growth. And that combination of profitability and growth. So although the paper focuses on revenue as a metric, and I know a lot of maybe traditional investors would be like, yeah, but what about profitability? But I think their point is, over some period of time, that just takes care of itself.
That's kind of an interesting concept right there. So let's dig into some of the summaries from this paper that are helping support this point. And I really appreciate you also saying that this is a concept that doesn't just have to apply to tech, software companies, right? This is something that you can really use across your entire
right. I mean, let's look at See's Candy. The most famous Buffett version of durable growth. That this is a company he paid $25 million for in 1972. I think he paid like 5 or 6 times EBITDA or something. And he didn't think he got a great deal. He's famous for saying that. And then in the 2012 letter or something, or 14 letter, he said that See's the box candy business hadn't grown at all in volume. So the volumes actually had been flat all that time, but the company had produced more than $2 billion for Berkshire shareholders to be reinvested. And of course, since then, it's probably produced, the laws of compounding. It's probably produced another couple of billion. And it's because at the end of each year, the day after Christmas or something, and I could be completely distorting this, but after Christmas, they raised the price by 6 or 7% of all the chocolate. So it's the compounding of the durability of that pricing power. And obviously, maybe this year they would raise it by 15%, but it's that durability of the pricing power, not the unit volume. The unit volume, they realized, didn't require growth at all when you had such incredible pricing power of the actual product. So yeah, this isn't just unique to tech. This is finance. This is investing. This is just a business concept. But tech, again, back to kind of the eye of the storm. I think this is, it's a good place to at least start to think about what we'd be looking for if we're eye of the storm investors. If we're looking for the company that's going to, or looking for a handful of businesses that's going to really do well, or that's potentially really oversold, we want to think about these things. We want to think about durable growth. We don't want to just look at valuations. We don't just want to do a screen for price and say, okay, well, it's down 90%, or it's trading for net cash or something. So somehow that's a great deal. Maybe it's a double from here, but if you're looking for the multi-baggers, you're going to think about a business more than just. I mean, what's going to be more important than just price is durable growth.
Very good. So then, what would you say are some of the criteria? Let's say somebody's listening to this. We're putting this out. Everybody's probably listening to this. It's October, I think 13th that we put this out. And they say like, okay, Jeremy, I got you. I'm in it. Durable growth. Love the concept. Read the paper. Great concept. Want to apply it. I want to make let's at a minimum, I want to screen out for what, maybe a swath of what quote unquote are durable growth companies. What are some of the criteria?
Yeah. Well, the paper, has some interesting examples in here. If I have the paper actually here. So the paper looks at like the components of the returns of these businesses. So what percentage was multiple expansion? Like I said, what percentage was based on durable growth net of dilution? And the overwhelming majority came from just revenue growth. But they point out, so I think the first thing to do is look at the history of success of some of the best examples and think about how were they successful, and try to use that as a little bit of a filter or a lens by looking at other companies. And one of the more successful outliers, I guess, in this example is Salesforce. And Salesforce was a company, I definitely didn't follow it back then, but according to this, this company was growing at 50+% a year before the financial crisis. And that revenue growth was cut down to 20% or something during the financial crisis. They laid off staff. They were able to hold their margins steady, and they were able to maintain market share initially, and then start growing market share. So I think the AIR or the ARR, the revenue essentially of the business since IPO is up like 800x, but the stock is up, I guess, a little less than 70x, which is still impressive over a 20-year run. But the value that was created was not due to necessarily the continuation of the growth in the revenue. I don't think you could predict that. I don't think you could ever just look at a company and be like, yeah, it has to grow at, I predict that it's going to grow at 25% a year, 30% a year. Because you don't really know how it's going to grow. But I think you can start looking at the quality of the business and say, is management overdoing it? Because the paper talks about the challenges that recessions bring on for tech businesses, but these are the same challenges that the recession brings on for all businesses. So some of the examples they talk about are sales cycles become extended, become longer. Okay, that's for all businesses. Margins compress or inflation goes up. Okay, that's for all businesses. Maybe it's there's a lot of pressure. It's hard to hire the right people. Okay, that's either because you can't afford it or because they're scarce. There's a lot of pressure on margins, and then there's just a lot of difficulty running a business during during a recession. And how the business is responding to that is going to tell you how. So there isn't a magic formula, is the point, I think, of the paper. There is never going to be a magic formula that you can screen for, but you would have to study. You would have to go back and study. You'd have to go back and study Salesforce and see that they were holding the line, that they were not cutting too deep. Yes, they were firing staff or they stopped hiring, but you'd have to do the work to see that, they can still maintain their competitive position with the staff that they have, and they're not losing their focus. And are they using this opportunity to gain market share because smaller competitors that aren't as well capitalized are falling by the wayside? So that's one thing we want to see with our portfolio companies as well. We want to see that they're gaining market share, and then they're in a superior position because of the cash on the balance sheet, or because they're controlled by a management team that is not just kind of withering away and dying and crawling into a hole during a crisis, but actually really going for it and taking advantage of that hole that's blown out in the competitive landscape. So I think it's really more of a business question and business analysis that's very much micro, that's very much business specific and business focused. And it's not a great answer for the kind of investor that wants to hit a button and do a screen and make a very snap judgment call on whether a sector is overvalued or undervalued and look at the past as a proxy for the future. I think you have to kind of find a company that you like or that's in the eye of the storm that you're interested in, and really dig deep and say, wow, is this thing becoming stronger as a result? Or is it becoming weaker as a result?
Oh, no doubt. And that's what I meant, is like, okay, just to get the screen to like kind of get started, right? And then kind of going through that list and say, okay, let me, I got my start. Now I want to go from here. So like, and on that point, I mean, obviously, you want to listen to conference calls and hear kind of any kind of media that these companies are probably doing. So what are some indicators from either conference calls, transcripts, or interviews with me that are some things maybe you would want to really hear from management teams when it comes to like, okay, this is kind of what I want to, at least from one side of things, at least what you want to hear. Obviously, then there's execution, but at least what you want to hear.
So I'll start by saying, so I went back and looked at some of the companies that I was interested in investing in and working on, kind of eye of the storm companies in banks and construction companies back in 2008. And I couldn't find all of them, but I found some notes and I made a list of the returns. This was a sector that was down 80+%. And I made a list of the companies, and ultimately, if you had bought all of them at the bottom, how they fared. And it's a super interesting list. So just thinking about banks, some of them like Bank of America were up 1,200%. PNC was up 1,100%. There were several up 2,000%, 1,000%, et cetera. But there were actually quite a number of them that were only doubles. There's one that was up only 200% right over the last 13 years. This is from a very, very low base. And it was the same with the home builders. There were some that were up, barely made it. And then there were others that were up 10 plus X. So I guess I would start by saying you can buy the basket, and the basket will probably do really well. But if you really want to dive deep, it doesn't take a lot of work to distinguish quality between, for example, like I remember looking at Bank of America kind of back after TARP was introduced. And I remember David Tepper going on CNBC and like pointing his finger at the TARP bailout program and arguing with, I don't know, Becky Quick or somebody like, no, don't you see it? Don't you see it? And they were saying, how do you have the confidence to invest? And he said, look, there's this TARP program, and people still didn't get it. They're like, yeah, but can't Bank of America still go to zero? So yes, it was the TARP program that saved Bank of America. But at the end of the day, why did it outperform so much more than many of the other banks below it? Well, it's because it was the quality of the business, and it was the quality of the management team and how aggressive they were at cutting costs and waking up and saying, like, we don't need as many stores, for example. One of the first things they did is they set out on a multiple, 2 or 3 year period of just closing down branches. And the second thing they did is they turned every single consumer-facing employee into basically a salesperson. So we don't need any fat. So they trimmed the company down. They focused on wealth management, so high return businesses. They weren't as dependent on lending because I think they knew they weren't going to be as aggressive in lending going forward. And they really they became a much higher quality business over that period of time. And so it wasn't something you could have identified overnight necessarily. I mean, maybe Buffett did because he made a big investment in Bank of America at the time. But I think you could look around and maybe try to find something that you can grab onto and say, wow, I think these guys, they seem like, I look at the plan, I look at what they're going to try to do, I'm looking at this, I'm looking at the assets they have, I'm looking at the markets that they want to be in, and see that they have a chance and to potentially outperform or be better than, and start following it close. So that's a long-winded way of kind of taking it maybe back to today. Today, if I was looking at, when we're very much in the market of looking, we're looking in the eye of the storm today. We're looking at all kinds of businesses, but the area that we think might be the most attractive coming out of this is going to be technology businesses, because it's such a wide variety of companies that are out there that have all kind of come down similar levels. And within the rubble, you're going to find businesses that have a lot of cash on the balance sheet, that are controlled by a management team or even a founder or a group of founders that are really focused, and they're not going to, for example, let the business be sold for a discount. The end markets are only growing, are getting more interesting. They may take a big dip, but over the medium term to long term, you can clearly see this isn't going away. So either on the enterprise side or even the consumer tech side, and so I would start by saying, you could probably do a screen for a lot of the SPAC asset light SPACs, and you can put them side by side with a company that's been public for 10 plus years. Maybe it's been around 20 plus years, and maybe it was overvalued. Maybe the price got ahead of itself. But now today, look, they're both down 80 or 90%. They're both trading for 2 or 3 times revenue, and you can imagine a situation where in a more disciplined environment that we're going into, that how each of those businesses would look. And so you're starting to see layoffs. You're starting to see companies realize, like in all industries, like, wow, we've got stock-based comp, we've got employees, we can't just have our stock go down forever. And so we're going to shift from kind of not showing a profit to showing a profit. So how easy is that for that company? So there's companies that are just saying, yeah, we're going to cut 10, 15% of staff. And what is the effect on the business's financials and on the business itself? So these are the questions I would be asking. There are businesses that can't support a 15% reduction in their staff necessarily overnight. There are businesses that can. They were just bloated, but they're wonderful businesses. Software businesses that were just bloated because that was the thing to do. Just, hey, hire, Tom's friend. He's also a great engineer. Yeah, well, maybe we don't need that engineer anymore. That doesn't mean that the business is a terrible business. So thinking about businesses dynamically and one-off, more so than just taking a bird's eye view of like, hey, this is the multiple and the multiple needs to come down, and until we see GAAP profitability, we can't buy this thing, or until we see operating margins that are above X, then we can't buy this. But looking to see what is the business doing, like Bank of America was. If you kind of looked at the plan they laid out in 2009, it was very, very interesting. It was very drastic. In 2010, they really started a whole transformation of the bank. And I guess you could have looked up and said, hey, no, that's not, we're not going to bet on that. We're going to wait until after. But you could have looked at the things that they were doing, and they were like, okay, we're going to close whatever thousands of branches. We're going to fire a bunch of people. Like, is it really that hard to handicap the execution risk around that? So we face something similar today with some businesses, at least some technology businesses, where it doesn't take a lot of imagination to see that, what the P&L would look like if they cut 10 or 15% of their staff. And a lot of them are in the process of doing that.
Very good. So, listen, we're a microcap show here. We cover everything more or less with a lot of guests that we have on here. But how would you adjust this concept for, let's say, some of our microcap focused folks that are listening in right now? Right? And
absolutely.
So
microcaps. What I'm talking about has nothing to do with the size of the business. I mean, if you look back at the Eye of the Storm investing in 2009, I mean, the majority, there were hundreds and hundreds of companies in the U.S. in the microcap and nanocap world that were trading for less than cash. I mean, today you've got at least a couple hundred trading for less than cash, but back then, I remember the screen, there were hundreds, 500, 600 of them. Maybe there were even more at some peak. And that includes the nano caps, maybe a 5 million market cap. But the story of those businesses, so if you look back at the companies that were the cheapest microcaps back then, and you look at the ones that kind of are still alive today, how did they perform versus whatever index you're using to benchmark yourself? And I think you can kind of see very quickly the differences in quality, and that valuation only goes so far. So the ones that really did well, I'm trying to remember a microcap that I might have owned during kind of the eye of the storm back then. Was it maybe Medifast? Medifast, maybe it's not a microcap anymore. Maybe it's $1 billion plus market cap now, but I remember it being a much, much smaller company compared to, and they ultimately did very well because there was a quality business with durable growth. Now it's very volatile growth, and maybe it's growing much slower today than it was, back in its heyday. But it was the durability of that growth that mattered. And an alternative example was a huge mistake that we made as a fund, I think in 2012. We had this idea of, kind of shaking up these microcaps that were really cheap and forcing them to sell, or finding a private equity buyer, because we just couldn't understand how they screened just so cheap. And one of the targets, or the companies that we bought a substantial stake in, still under 5%, but the company was so illiquid and small that it felt to us like we owned 50% of the company. It was called Vicom, VII. I don't even think the business exists anymore. It was a little microcap trading for less than the real estate and the cash on the balance sheet. And it just looked so cheap. And the founder had invented the CCTV camera, which kind of sounds funny to think that there was this little microcap company that invented a whole sector, but it was still a microcap. And somehow that just went right over my head. All I saw was there was this really cheap company that invented the CCTV camera that had, millions of cameras installed all over, a lot in Vegas. And they had this maintenance revenue, and it just looked so enticing. It looked like, wow, this should be, there's a big arbitrage here to be had. And so we built this position, went to the company and really rattled the cage, called a bunch of investment banks, and actually put the company into play. They tried to sell the company unsuccessfully, and I couldn't understand why they weren't selling the company. And it just turned out that the company was just a rapidly melting ice cube. And ultimately they merged with another company that was a similarly melting ice cube. And I don't even think it exists anymore today. And the lesson was, and it was a loss and it was terrible. We spent a ton of time on it, but investors got so excited because they saw this big discount on paper, and they owned the real estate, and we had a broker do an assessment of the company's headquarters in upstate New York, and it was just exceeded the value that it was being carried at by 10x or something, and it just had this really fun story to it, that we went and discovered it. And in the end, it was a loser because it was a very low quality business, and it didn't matter how cheap it was. It mattered that, you couldn't liquidate the business fast enough. And that's one of the reasons it just didn't work. So I think right now you're going to find, if you screen for cheap companies in the microcap land, you'll find a lot of companies that are going to be similar to VII, companies that shouldn't have been public. And look, I don't want to name some of the lowest quality companies that I think are low quality companies I've seen, because they may turn out not to be low quality companies, and I don't know them well enough to have that kind of judgment. With VII, it's a past tense thing. It's something that's already happened. It already melted. But there are many, many companies that went public, and not necessarily just in tech, that are trading for at or less than cash. And when I look at them, I just shake my head and go, oh, this is another, train wreck waiting to happen. So yeah, I guess you could buy a basket of these that have gone down a lot, but spending a little bit of time and thinking about durable growth. It doesn't need to be high growth. It can be a See's Candy situation, which was obviously, they probably wouldn't be down 80 or 90% if it was See's Candy, but thinking about them in terms of the durability of the growth, and what is going to protect that durability, and what's going to allow them to be able to come out of this, more valuable than they went into this. And a lot of that's just not going to be available by doing a screen, like I said, or just taking a real snapshot look at the past. It's really more of a deep dive into the company itself. And that's why it is such an exciting time to be an investor.
Very good. All right. So, we're about there. And my last question for you is, this actually pertains, our next issue of the magazine is coming out very shortly. And the main theme of this issue happens to be fallen angels, and fallen angel stocks and opportunities there. So, with this idea of durable growth, is there a difference between the idea of, and this concept of durable growth companies and fallen angels, or is there a ton of overlap?
Well, the market we're in right now is not distinguishing between durable growth or the potential of a company to have durable growth as a result of them becoming more efficient in this downturn. It is not distinguishing at all between the two. So I'd say everything is down. So you're going to have gems, really amazing gems in there. They're going to have babies thrown out with the bathwater, as they say. So just because something is down a lot doesn't necessarily mean that it's going to mean revert and go back. But I think there are many examples like this paper highlights of companies that are down a lot, that really are fallen angels, that will emerge stronger, that are repositioning themselves to emerge stronger and compete, albeit maybe at a lower growth rate, but that are positioning themselves to be stronger. And those, in fact, are the fallen angels, because they will come back, and they will come back much, much stronger, and probably make multiples. You'll probably be able to earn multiples on your money and recover everything, even from the peak. Because that's what this paper points out, is that if you bought the best companies during the financial crisis, you made this great return, but in the end, they ultimately became more valuable, much more valuable. They became incredible investments, even if you had bought them back at the peak time. And that's what's great. I mean, for all the overvalued .com stocks, you name them, the higher quality ones, ultimately, even if you had bought them at the absolute peak, Microsoft or Bookings, or they ultimately were great investments. You probably don't want to wait around. Most people weren't willing to wait around a decade or whatever to get their money back. But in the end, because they had durable growth, the money wasn't lost. Definitely.
Absolutely. All right. Well, Jeremy, I think that's a great place to end it. Any final thoughts on this topic? What folks should think about, maybe your parting thoughts before.
Yeah, I mean, I'd say now is really the time to take a hard look at companies and try to distinguish between the long-term winners from this point going forward, and not try to get so caught up in just screening for prices, because you'll probably do well if you buy a basket of things that are down a lot over the next few years, but you'll probably do a lot better if you're able to just distinguish a little bit between quality and price. So it's not easy, but it's I guess what we love, and what all your viewers, including myself, it's what we live for. It's what we love.
Amen. Amen to that. So
from that perspective, it's a great time to be a public company investor.
Yeah, don't look at your portfolio. just look for just look at new ideas, or the ones that you're really passionate about that are down.
Right.
Yeah. Well, Jeremy, thanks so much again for joining me today. Where can folks go and find more information on you, follow you on social, the whole?
Yeah, jdpcap.com. If you're a qualified or accredited investor, you can sign up to receive our updates.
Very good. All right. Well, Jeremy, thanks so much for joining me today. Really do appreciate it. Good luck. Stay safe.
Thanks for having me.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.